Firstly, thank you very much for joining us today. We're really excited to be running this introductory webinar. What we'll do first is just give a brief introduction to myself and Ewan as the hosts for the webinar, and then we'll talk through what we're planning to cover. So introducing myself first, I'm Anna Orriss-Baxter. I work at Baringa Partners with banks on large global transformation programs, largely within the payment space. This is the area that I get really excited about, and particularly any innovations that are happening in the market. And through that, I'm the lead for our Web3 campaign, and this includes hosting our Trailblazers podcast, where I speak to a guest from industry and Baringa about some of the exciting changes that are happening as a result of Web3. So I'm really excited to touch on some of those themes today. Ewan, would you like to introduce yourself?
Yes, absolutely. And good afternoon to everybody on the call. Thank you for joining us. So Ewan Smith, I am also at Baringa Partners. I work as part of the CFO advisory practice. My background is really financial services. I have lived and breathed it for a good number of years, but I have always been very, very interested in technology. So I've kind of lived the finance/technology lens. Working at Baringa Partners, helping clients also deliver their transformation programs, understanding how technology can be used better. With Web3, though, I have had an interest and have been following the ecosystem now for almost a decade, which probably makes me one of the earlier people to get interested and follow the developments. And so, yes, really excited to be here today to share our insights with everybody. Anna, back to you.
Thanks, Ewan. And if we move on to what we're aiming to cover, so today you can see that Ewan and I are aiming to go through quite a foundational level of Web3 and what it is. What we're really keen to do is that we sidestep some of the noise that you might hear in the market around volatility, things like fraud, crime, some of the environmental challenges. Whilst these are absolutely important, they are just noise unless people understand the basics and can form their own opinion on them. So that's really what we're aiming to do. We similarly won't spend a lot of time on regulation and DAOs or decentralized autonomous organisation for the same reason, although we are more than happy to have any follow-up discussions on these topics should you want them. Our objective really is to leave today with everyone on the call feeling a bit more comfortable around what Web3 is, how it works, some of the exciting opportunities and also some of the threats to be aware of, but ultimately what does it mean for financial services. So as we go through, I'll start by covering what is Web3 at a high level. I'll then hand over to Ewan, who will get into a bit more of the detail around the different building blocks of Web3 and what it is, and before we bring it back to what it means for financial services. So let's start actually with some of the headlines that you might be more familiar with. And I think for people who aren't living and breathing Web3 day to day, these are probably some of the common things that you might see within the media. The first and the top half of this slide really focuses on investments in non-fungible tokens or NFTs. And Ewan will talk in more detail about what these are later, but effectively they're one of the digital assets that form part of Web3. And often when you see them in the news, it's with news about the really quite obscene costs and price tags that some of these NFTs have. So you'll see on the top left, you've got Beeple's every day, the first 5,000 days. So this sold for $69 million and is really quite a record breaking in the art world, let alone digital art for what is effectively a JPEG. Similarly, CryptoPunk, these are 10,000 images of punky looking people selling for things from the thousands right up until you'll see on that example 2.6 million. Another one that people will be quite aware of, although it's not on this slide, is Jack Dorsey's Twitter tweet. So the first tweet sold again for 2.9 million. Before plummeting in value by over 99% around 2 years after that original sale. The highest bid at an auction was $280. So really often what is in the media is these expensive kind of artwork, pieces of NFTs, also some of the volatility in the market. And you can see that from the second kind of bottom part of this slide. There's lots of common kind of discourse around actually what are some of the challenges? Is crypto gambling? Actually, what are some of the market is so volatile, and you can see this even in the last 12 months. last November, I think Bitcoin and Ethereum, so the two kind of largest fungible tokens, were at an all-time high. Yet this year we've had some real shocks to the market. Things like Terra Luna that you can see on the slide crash in April, and recently it'll be fresh in everyone's mind, the FTX collapse just last month. This then opens up a lot of the questions around things like fraud, money laundering, some of the kind of regulatory debates around these digital assets. And I think often, because the focus is here, Web3 in its broader sense can be a little bit misunderstood. We've got deliberately as the title for this slide, is Web3 crazy? Because actually these are probably some of the common things that you're hearing. But actually, if we move on to the next slide, we've tried to show some of the flip side and again, picked some of the key things that are in the media. Apologies, Gary, can you just move on to the next slide? But here, focusing much more on financial services. Sorry, back on to slide 5. So this is why we wanted to share some additional headlines. And these give examples of how financial services is already engaging with Web3. You can see that some of the bigger banks, and I've put on there the example of Barclays snapping up a stake in crypto. So this is a crypto, sorry, in copper, a crypto exchange. So that's just one example of a bank trying to partner with some of these new entrants. Similarly, MasterCard is on there, but we could equally have put Visa. So in terms of the biggest kind of card duopoly, they're really thinking about how they can help to facilitate crypto. MasterCard have a crypto source, which is basically their offering to enable financial institutions to bring secure crypto trading capabilities and services to their customers. As I said at the start, I work in corporate banking. So one of the things that I get most interested about is actually this interoperability between different countries and how that can be enabled. So something I'm following closely is the central bank digital currency pilot that Swift are running. So here they're really working with 14 different banks and central banks, piloting how cross-border payments could work for these central bank digital currencies. I've then picked a couple of quite different examples. So if we take one extreme, we've got JP Morgan, who are really quite leading in this space, actually. So they have a blockchain center of excellence. In 2020, they launched Onyx, which is basically their bank-led blockchain platform that allows for information sharing and digital asset sharing between different organizations. And then if we pick a kind of neobank challenger example, we've got Revolut here. So these are actually, you might have seen in the news in the last couple of weeks, Starling have gone a completely different route with this, and they restricted their customers from making any crypto related payments. So actually you're not even able to use a Starling card for anything related to crypto. Whereas Revolut have a different approach. They've got something quite exciting called Learn Crypto, Earn Crypto, where actually through completing training courses and upskilling yourself in crypto, the market and how it works, you're then able to have tokens as a reward put into your digital wallet. So really trying to make this accessible to a lot of people. The final example on here is a slightly different one, just to show some of the breadth of Web3 that, like I've mentioned, we'll get into the different building blocks. But here we're calling out an example from the metaverse. So whilst we typically think about financial services and Web3 and more of the crypto and the digital asset space, actually there's much broader opportunities. So HSBC is an example of this, using the metaverse, building on that kind of virtual reality world, thinking about gaming and what they can do with this from an advertising perspective and with their sports engagements. So that was really just a couple of slides to give a flavour of how Web3 might be talked about. But we'll now move on to the next slide, where I'll give a high-level definition of what Web3 actually is. So first thing to say up in here on this slide, and the subtitle probably sums this up quite well, is that there isn't one answer. I think if you ask 10 different people what they mean by Web3, you'd probably get 10 very different answers. But there are some distinctive characteristics that there is alignment on. And it's effectively a suite of technologies that move us towards a global, borderless, permissionless economy. That's probably quite jargon heavy as a definition, but if we start to break that down, what does it actually mean? So Web3 technologies give the consumer owner of their own data. So where we used to have kind of big companies with their huge data servers storing customers' data, we kind of moved away from that. And you've seen some of this backlash, I'm sure, in the media with kind of the response to Facebook and some of the data questions there. Actually, with Web3 technology, individuals are able to own their own data. It's stored on a ledger. There's that very clear audit trail and understanding of how it's used. So that's probably the first characteristic. Second one is permissionless and open source. So by permissionless, this means that anyone is able to participate. And by open source, we've got code that is freely available. It can be developed on, it can be improved by any interested party. And what this means is often you'll see people talk about Web3 as both the curator and creator economy. And this is really that in action. So instead of just being a recipient of content that is put out by big companies on the internet, actually you can genuinely engage in it and you can build and contribute to that code yourself. So you're able to be both in that creator role and the curator or consumer of that content. And then finally, decentralization. So there's not that single owner or middleman. So when we talked about Web 2, we had the kind of big companies, the likes of Google, Microsoft, Facebook, that really led that movement. But with Web 3, whilst they still absolutely have a role to play there, there is the ability for, there's not that same kind of middleman facilitating the activities. There's the ability for much more individuals and smaller companies to really contribute. So it's a very high level as to what Web3 is. I'll now hand over to Ewan, who'll give a little bit more of the history of how we got there and break down some of these components in more detail.
Thank you, Anna. So I'm going to start off with a probably massively oversimplified view of kind of historic economic development. So just to conceptualize and essentially frame what Web3 really is and the role that it plays and how it's different from what we have today, both in terms of how the economy is designed, but also what Web2 represents. So if we take ourselves all the way back to early human interactions, it was very much a barter economy. People were very generalist. There was no real need for specialist skills because it was very difficult to trade a specialist skill for something that you might need. And everything happened very locally. It's to travel far to be able to exchange whatever service you had or whatever product you had for something you were looking for was limited by the amount of time you had and your ability to travel there and make that exchange. So it was very local. It was very, very simple and was very inefficient because if you wanted something, it was entirely dependent on the fact that that was nearby and you'd be able to make that exchange. As we progressed and technology improved, and a little bit of a wink to the accountants out there, perhaps, general ledger technology and accounting technology improved, it enabled us to organize ourselves much more effectively. So we started to congregate in larger cities. We started to be able to track and measure value exchanges between different people. We became more sophisticated and specialized because of that, because we could track the value that we delivered through the specialized skill we did, and we could produce much more complex and interesting products as an extension of that. It was more efficient because we could track and measure how we were doing things and how goods and services were being delivered. But it still remained largely local because information technology had not grown to the point yet where we could start to coordinate very sophisticated supply chains. So more efficient, a little bit more complex in terms of specialization, but still relatively local, but in a more broader sense. That then brings us to the global economy, which we have today. Technology has evolved significantly. We're able to coordinate very, very sophisticated international supply chains. We're able to interact very effectively through those, but it's become highly centralized, which means that the dependency on key players in the market to be able to facilitate or provide those services that you need to be able to do the coordination is very, very high. And there's quite a large amount of cost in that, and also control and ownership that Anna touched on earlier, is you give up a lot of control to those third parties, and there is that counterparty risk that is involved. So today, global, very, very complex ecosystem that we operate in, but it is highly efficient and very, very effective. Web3 as a global borderless permissionless economy essentially allows us to go back to those first roots where we were interacting directly with people to do that value exchange, except now we do it on an infrastructure which Web3 is providing, to be able to do it on a peer-to-peer basis. Now, that peer-to-peer might be a user to a user, it might be a company to a user, or a company to a company, but that service can be provided directly without requiring somebody to coordinate it for you specifically, because the technologies provide that infrastructure for you to be able to do it. So this does significantly change the paradigm that you now can control and own your own content, your own products, and you can choose your customers, and your customers can choose you much more directly, and you can do it from, if it's a service, from any country to any country, obviously within regulatory requirements, but it allows people to interact much more directly, which is quite a fundamental change in opening up the economy to all participants, which is, to me, a very exciting feature. So we move to the next slide, please. Excellent, thank you. So what are the building blocks of Web3? And I'm sure that you'll have encountered parts of these or most of these in your everyday interactions with media, news, conversations around Web3. But it's the bringing together of all of these technologies which really creates the exciting platform that Web3 is. So we have the metaverse as the top of the pyramid. And what I've done is I've done a read across between our traditional economy and what Web3 is, just to try and contextualize it a little bit. So it's easier to be able to relate to, because I've often had conversations with people around Web3 technologies and they've walked away going, that was very interesting, but I'm still not too sure what it is. So this approach, I think, has been more effective in helping people really conceptualize it. So the traditional economy, you start off with places to trade. You go to the store, you go down to your local market, you go online onto the internet, and those are channels for you to be able to interact with parties whose services or goods you'd like to either procure or essentially provide. The metaverse creates an equivalent marketplace within the digital realm. So you can create your storefront, you're able to create and today you can go and explore them, your digital art galleries, you can go through to Nike stores, you can go and to casinos, you can go to any number of different places. There's even war memorials that are available to visit in the metaverse. So this is where people can congregate in a digital fashion to be able to interact either directly using virtual reality technologies or other available communication technologies to be able to converse, coordinate, collaborate, create, or exchange value. The second component is governance. So we have central governments organizing countries today. We don't have a picture of it, but you have companies and organizations will have their own governance structures as well. In the same way, we're having decentralized governance models being created and developed. We're not going to go into huge amounts of detail because it is still an evolving scope. We have lots of legal considerations and effective control considerations that need to be thought through. But DAOs organize and essentially coordinate through a governance model what happens within the networks that they're controlling. So that could either be a specific entity that's been created for the purposes of lending. It could be around network management. So the next stage down where we talk about, well, right at the bottom, we talk about distributed ledgers. You can have DAOs that essentially govern and coordinate what happens within that ledger. So what are the next promotions, the developments that need to happen? What new features will be created? What are the rules for participation within that network? Those are done through and controlled through DAOs. And there's different ways to get access to a DAO. You could either, as a participant within a network, be able to have a stake and a say in what's going on, or potentially you could have to do some special activities to be able to either secure an NFT, which will give you rights to governance, and that enables you to prove that you've got the skills or capabilities to be able to play the role or make the decisions in an informed way. Very, very, very much the case of early days for how DAOs will progress, and I think it's a very interesting space to watch. And there's lots of really interesting psychological concepts that go around it as well, but I'm not going to go into game theory and the lovely aspects there. The next layer down is in an economy we're trading things. There's goods and services being offered, and there's ways to do that. So digital assets are the equivalents of commodities and services in the digital realm. So we have our non-fungible tokens, we have our fungible assets, which most of us will recognize as cryptocurrencies and stable coins. And then we have our central bank digital currencies as well, which is a very exciting area of development. these are the items that will be traded. And when we go through the next slide, it'll be quite interesting to see what they actually are, what they represent, and where the opportunities are within them. And then the final layer is the DLTs, but it's not just the distributed ledgers, it's the technologies that go alongside those. So the ability to have a semantic web, which enables participation of technology within the ecosystem. So today in Web 2, it's very much a person interacting on the other side, and we're looking at a website, reading a web page, and we're interacting with it. A semantic web enables computers to be able to actually read and interact with the web. So it opens up a much bigger economy where actually you can deploy assets directly into these networks that provide goods and services themselves and are able to communicate with each other, be it facilitating transactions, payments. A very simple example of that is future vision. You're driving down the road in your automated car, self-driving, reading the newspaper. You go past a toll booth. Your car speaks to the toll booth, informs it that you're going past, provides it information, and agrees the transaction to pay the toll charge for you. So a very simple example, but that's all done digitally. That's your car essentially communicating with the toll at that point, and there's no human or third-party intervention required. AI and machine learning, obviously very exciting areas. These are really empowered by the nature of distributed ledgers and blockchains. So the ability to be able to get clean, structured data, high volume information allows you to deploy these technologies really effectively. Hands up, I'm not an AI or machine learning expert, but looking at what is happening in those spaces is incredibly interesting. And I can definitely see the role AI will be playing in future by supporting the infrastructure around the Web3 universe. So shall we move on? There we go. So digital assets. Now, this is the really, really exciting and also possibly quite misunderstood part of Web3. So we have our NFTs, which are non-fungible tokens. When Anna spoke to them earlier, largely today, NFTs are identified as digital art, and they have come with really exorbitant, eye-watering price tags to them at times. But that's not what makes an NFT very exciting. So at its core, an NFT is a non-fungible token. So it's an item that is uniquely created, and it may be unique in a batch. So you could have 10 items or 10 assets which have the same features, but each of them are unique in and amongst themselves. And that gives you some form of entitlement or control. So it might be ownership of an asset. In the case of today, that's digital art. In tomorrow's world, it could well be your property deed is an NFT. You could have access to your house could be an NFT. Your car, your watch, all of your equities or any investments that you hold could well be in an NFT format, which allows you, therefore, to have the ownership and control of it. But NFTs are programmable. So the fact that it's non-fungible doesn't mean that it's permanent. You can have an impermanent NFT as well. So you can program in a lifespan for it. So you could say you have this particular right, be it, say, a club membership. You have the right to use that NFT will grant you access to a particular club or facility, and that will expire automatically at the end of a period. So let's say I sign up to Tate Modern because I love art, and they issue me an NFT. It gives me 1 year's worth of access. I then use that NFT to be able to sign into go and view the Tate, and at the end of the year, that automatically expires. It's no longer going to be valuable. And I then renew it, etc. So you can control memberships through it. There's other features around fractionalized ownership, where you could have a single asset and you could issue a series of NFTs to indicate participation in those assets, which is quite interesting as well. But you can also then do other programmable aspects of it. So one concept which I've kind of ideated myself is around bank accounts. Your bank account essentially is an agreement. It's terms and conditions that you have around how you're interacting with a bank. If you issue that as an NFT, you can essentially pre-program that with the terms and conditions that you're interested in or you're agreeing to sign up to, and you now have security knowing that that NFT represents your terms of services, and you can verify that the services are being delivered in accordance with that NFT through an automated way. So be it looking at transaction pricing that you're undertaking as a counterparty to your bank, making sure that your bank fees that are being applied are correct, your mortgage is correct, your lending rate's correct, your deposit interest is correct. So all of that can be captured. And that opens up another exciting aspect in that you can start to create really custom and bespoke relationships with counterparties, and those NFTs reflect those agreements, and there's trust between the two parties because it is an immutable agreement that is secured digitally on the web. Moving on to fungible tokens. Fungible tokens are, as I mentioned, the standard cryptocurrencies that we think about, and we have a few up there as an example. Please do not take those as any form of advice or recommendations. They're not. It's just an indication that there's quite a broad range of different fungible tokens. Fungible tokens play an interesting role in the ecosystem. So they usually get equated to money. So they're cryptocurrencies, they're viewed as currencies. And that is in part true for some of them. Some of them, they are designed to be means of exchange to facilitate transactions, but they do have a broader role within the ecosystem. So in creating a network or a distributed ledger, you're looking to be able to incentivize people on a distributed, decentralized basis to participate in that network in good faith. And so you want to be able to reward people for having essentially participating positively within that ecosystem. Equally, you want to disincentivize people from malicious behavior. So one of the key things that a fungible token needs to do is to be able to create that incentivization mechanism. And the next slide, I'll touch on it a little bit. So kind of just flag posting that around how tokenomics work. But no, not quite yet. Let's not jump to the next slide. But the role that it plays has to make sure that participants in the network are secure, as well as being the means to be able to transact value between counterparties. The last one being central bank digital currencies. So these are not necessarily going to be issued on blockchains. They could be issued centrally through central banks, but they are the fiat equivalent tokens that will be issued that are essentially money, but they interact in the digital ecosystem in the same way as the other equivalents, which are stable coins. Now, stable coins are fungible tokens by their nature, but they're essentially digital assets that have been created and have their values pegged back to a fiat currency. So be that a £1 or be it a US dollar, and they aim to maintain those pegs. There are two different ways that stable coins are issued. So one is essentially being backed by highly liquid assets. So that is containing reserves, and if somebody needs to withdraw fiat or convert a digital asset into fiat, they're able to honor that transaction. The other one, which is a little bit more technologically based, is like the Terra Luna was, where it's an algorithmic stablecoin, and it looks to use an algorithm to be able to create that stablecoin to maintain the peg. We haven't seen very many examples of successful algorithmic stablecoins yet. So currently, that's still to be proven as a technology. But those are your two stablecoins. Right. Now we can move on to the next one. Right. I wanted to spend a little bit of time just talking about DLTs and tokenomics more broadly. And this is really just to help people understand that a distributed ledger, when people talk about it, they usually refer purely to blockchains. Now, there are two different technologies which are being used to build out distributed ledgers, and they have pros and cons to them, which I'll touch on very briefly. But understanding that the differences between the two is quite important. So your blockchain originates really from your Bitcoin technology, where it is a case of you have a distributed technology and every single block that gets written is done in a sequential way. So very much like a train, where you'll have one carriage coming past at a time. You cannot have more than one train on that rail, and each coach represents a block of transactions that are being done, and the next block of transactions gets verified against the one that came before it. So the preceding coach is validated, essentially gives you the state of the ledger. The next coach then updates it, but references back to the block. A DAG architecture is what's been used in big data and is a very, very different type of technology, and it has significantly more scalability and transaction volumes to it. I'm not going to dive into the technical details of it, but it does work on a non-sequential basis where you'll have transactions that are happening concurrently and they get indexed and organized at a later date, creating that ledger for you. And the different transactions essentially do relate back to each other, and there's a validation process that's undertaken to make sure that actually the state of the ledger is correct and that the sequence of transactions doesn't allow for things like double spend. I've given again some examples of the different projects out there that are utilizing these technologies, but again, these are illustrative examples only. Consensus mechanisms is how the various different technologies agree on the state of the ledger. And there's two that are currently very well known, and that's proof of work and proof of stake. If you're reading the BBC this morning, you'll have noticed the discussion about Ethereum's transition from proof of work through to proof of stake. These two different approaches have pros and cons to them as well. Proof of work is notoriously energy inefficient, but it's incredibly high on security. So the way a proof of work system operates is you'll have a series of different entities, so computers, essentially challenging each other to be able to solve cryptographic keys as quickly as possible. And whoever solves and presents the correct outcome from that calculation, that algorithm, wins the right to be able to write the next block. So if we think of that train coming through, in order to be able to write the next block, you want to have security. You want to know that it's impossible for somebody to game the system. So you've created a randomized chance for somebody to be able to win the right to it based on a very complex calculation, which scales with participation as well. So what that means is nobody can predict who's going to win the right to be able to write the next block, and therefore they're not able to attack that particular computer to say, all right, we're going to try and insert transactions that shouldn't be on it or to manipulate the transaction itself. So that way you have trust that each consecutive block is being written by a randomized individual, but then essentially gets broadcast across the network to agree that the transactions in there are reflective of the ones that preceded. So you do have that network communication, but the right to actually undertake the transactions is randomized. So this is where it gets very energy inefficient, in that lots of people are looking to participate because they get rewarded for doing that, which is the tokenomic aspect of it. Is if I'm going to undertake work, I would expect to be able to get reward. And your reward for doing that is essentially an emission of digital asset tokens, and that therefore you can then sell those on for profit. So there's a self-controlling mechanism. The more that the digital asset is worth, the more incentivization there is for this high energy use activity to be able to try and mine the tokens. Proof of stake works differently. So here you will have validators that are being essentially either whitelisted by your networks, or you could have an open participation to it. But for a validator to be allowed onto the network, they typically need to provide some collateral, which is indicating their good intent to be able to engage with the network positively. So that is where fungible tokens come back in. So those fungible tokens on the network are what you'll be using as your collateral. And with the concept of using Metcalfe's law, that the value of those tokens will represent the value of the network. If the value of the network and the transactions that are being undertaken on it increase over time, the value of your collateral increases as well. So by behaving positively in a similar way to proof of work, you do get rewarded by being able to write transactions and be able to claim the fees on those transactions or receive emissions from the central network that is looking to actually fund and bootstrap the network itself. But you do so on a good basis, you add value to the network, and you see both an increase in the value of the collateral you've put forward as well as the rewards. If you behave maliciously, there's penalties to that, which is typically slashing. So if you're writing bad transactions and that gets identified when you broadcast across the network, you could suffer penalties. So there's a financial disincentive to being a bad actor within these networks, which is very important, as I mentioned, around a decentralized architecture. You don't know who's participating. They're not known to you. They're not known to other network participants potentially. So you want to be able to incentivize them to act in good faith. So that comes back to how the tokenomics get designed for these networks. Now, tokenomics is, again, very, very interesting. And also it's evolving very rapidly as to how do you incentivize a network and participants to be able to engage with the network in such a way that it doesn't become self-defeating. And that is a very fine line to walk. So if we cast our minds back to 2020, 2021, when the crypto markets were becoming progressively more excited and there was a little bit of perhaps too much jubilation, the values went up significantly. Interacting on networks like Ethereum became very, very expensive. So the value of the token went up, and therefore, as you pay your transaction costs in the tokens itself, that then became very expensive for normal people to interact with. So future networks and Ethereum themselves are working to try and find ways to be able to bring down those cost points. And that's going to be one of the real barriers to anybody engaging with a network, is you'll need to look at how the tokenomics work to make sure that you can ensure that that network in the future, if it does become very successful, doesn't essentially then create a barrier for future growth. So tokenomics is, again, one to watch going forward. Finally, a very, very simple overview as to how the ecosystem has developed over time. So we started off with Bitcoin back in 2009, 2010, which is a very, very basic ledger. It allows for transaction from one participant to another participant in a direct way. And that's it. It's the transfer of value. You can send tokens, you can receive tokens, you store them on your wallet. There's nothing else you can really do with that. When Ethereum came in and created the smart contract approach, which is simple consensus, it transformed the capabilities of blockchains and distributed ledgers in that now there's a mechanism which is auditable, which is very important, as you can see how the smart contract works. You can understand the logic that's being applied to it. But they're essentially very, very simple agreements of if this, then that type logic. So this allows you to create services on these networks, which is I will lend you X amount of money for X period of time in exchange for Y amount of collateral. You will pay me X or Z rate, and this will last for Y period. And that transaction can self-resolve over time. And if for any reason one of the elements is not essentially met, that contract will then resolve. So, for example, I lend you the money, you provide me the collateral, you do not pay me back, I retain the collateral, the contract resolves, and that then settles the transaction. Conversely, you settle up, automatically you'll receive your collateral back. I cannot actually take your collateral away from you and use it for other purposes. So it's all contained within those smart contracts. But these are quite simple. So, and it does lend itself well to financial services, but other businesses out there do have much more complex business models. And that's why we're seeing that custom consensus mechanisms are starting to be built out. And there's a lot of investment going into how do you create a mechanism on the chains to be able to achieve custom consensus, dealing with multiple variants, permutations of information coming in a way which, again, is transparent, clear, and auditable. So more to see on custom consensus coming. There's no really good ones out there at the moment, but hopefully we will see that as an evolution of the technology in the near future. Right, next up. Anna, back to you.
Thank you. So it's been really good to see some of the more detailed breakdown of these different technologies, how it all works and how it fits together. What I'm going to try and do now is bring it back to, okay, and what does this mean for us as people working in financial services? So I've worked with banks for the last sort of 10 years, focused in corporate banking. And some of the key questions that I'm starting to be asked now from banks is really how they can approach Web3. What are the things that they should be doing or shouldn't be doing? What are some of their competitors looking at the moment? So what we've done is pull together what we believe are the 5 key questions that we think banks and actually broader institutions within financial services should really be asking themselves. And the first one is actually, what is our Web3 strategy going to be? And this will vary depending on the organization, depending on the products and services that you want to focus on. But I think it's really, what does it mean for you? So if you understand some of these technologies, think about, do you want to offer digital assets to your clients? You can see at the start of this presentation that we've got some banks who are saying absolutely not engaging with things like crypto right now, others that are really trying to embrace it. So actually, where do you want to be? Similarly, do you want to onboard and service some of the Web3 clients themselves? This is things that some banks are looking at. Actually, how can they, if they want to take these Web3 organizations, as Ewan's talked about, they've got slightly different governance structures. So actually thinking about what does it mean to do KYC for them? What type of products and services will they need to be offered? Because it's not going to be the same as traditional organizations. Think as well about what are the implications of not having a Web3 strategy. So I think at the moment, a lot of this is at quite nascent stages, but you can see that there are players within financial services really starting to engage in this. So is there a risk of being left behind if you haven't thought about this and some of the opportunities or threats from Web3? And then that probably links into actually regulation. So how will you prepare for regulation? There is a more and more regulation coming to the fore. So we're based in the UK here. The FCA have been running their crypto sprints this year. We've had fairly recently Parliament voting that they will regulate crypto the way that they would, or fungible tokens the way they would some of the other financial products. So actually, there is more and more regulation being thought about. The markets in crypto assets regulation for Europe will be coming out next year and implemented in 2024. So actually, what does this mean? And because of the global nature of Web3 and some of the opportunities in that way, there's also an opportunity to really think about almost regulatory arbitrage. Where do you want to place yourselves and where do you want to offer some of these things? Because across the different geographies, there's going to be very different approaches to regulation that are appearing. Third question is, where do we see ourselves in the ecosystem? So actually, who do you want to partner with? There's more and more new entrants, disruptors, different kind of technology, fintechs that are coming to the market. Actually, what's the opportunity as banks who have the relationships with clients, who have the licensing agreements that are needed in what is effectively a heavily regulated market? Actually, what are some of the opportunities? What do you think payments is going to look like in the future, for example, to pick one use case? And how do you future-proof that position? There might be some, so I don't think the answer is necessarily going to be we're suddenly moved to Web3 and everything is Web3 now. But actually, there is going to be some kind of hybrid of Web2 and Web3 that will change over time. So where do you see yourselves playing and which technologies will you lean upon? And I think at the crux of all this is really question number 4. So what does this mean for your customers? If we're not looking at the impact across the end-to-end customer journey, so right from the beginning of onboarding, completing know your customer checks, customer due diligence, then making transactions, servicing those clients, maintenance of them, thinking about things like operational resilience, financial crime, offboarding at the end of that relationship. Actually, if you're not looking across that and thinking about where is it that Web3 could play and help you to solve, then I think that we'd be missing a trick, because actually it's really looking at what is the problem, how can Web3 potentially help fix that, and in some places it'll be Web2 instead. But I think that is the 4th question. And then once you've really understood where you want to play, what you want to do with regards to Web3, how you want to respond to it, there's a final obvious question, which is, and how do we get ready to meet that? And I think the first thing that I'm seeing a lot of banks starting to engage with is really just upskilling themselves, educating themselves, thinking about what are some of the different digital assets. What does it mean for them as a business model? Which of their clients would be interested in them or not interested in them? Similarly, with blockchain technology, there's a lot of kind of early proof of concepts looking at this, participating in things like pilots. So I think that's really a way that you start to think about how you can get ready to meet those longer term objectives. This is naturally, it's deliberately a circle here, because naturally your strategy is going to evolve over time. Web3, we kind of go on the kind of estimate that within 3 to 5 years we'll be moving much more positively in the direction of Web3, but at the moment it is still at quite nascent stages. So that was really all of the content that Ewan and I wanted to cover today. Ewan, is there anything that you wanted to add on this slide before we dive into some of the Q&A?
So just very briefly, and that's probably tangential to the slide itself, because those are really good questions. But I think it's if we look at the evolution again of the ecosystem, it started off originally challenging financial systems directly and financial models, and was to be the alternative to those. We haven't really seen the real economy starting to really get involved and adopt Web3 technologies. They've not been sophisticated and evolved enough to really be able to support a lot of the other products and services. We've seen forays and use cases around validating data, making sure things like medication prescriptions, they are essentially verified, and you can make sure that the medicines that you're purchasing are in fact legitimate and not counterfeits. So there are some use cases of that, but it's not really prevalent. What we'll see is more and more adoption of these technologies, given the developments over the last 3-4 years, that has allowed them to start partnering up with these clients. And we'll see it with that adoption. There's actually, I think, more of an incentive for financial services corporations to be able to get involved with this space, because their customers themselves will be interacting with these ecosystems, and they'll be looking for support and products to be able to help them mitigate and manage their own risks, and also just facilitate transactions. So I think it's the right questions, but it's just a little bit early, but it's going to be here very soon that we'll see real world adoption with real world entities becoming much more involved.
I completely agree, Ewan. And thank you to people who have submitted questions to us. We did gather a few, and Ewan and I have both picked a couple to answer. We should have time to do so. So the first one that I chose was, do you think the adoption and integration of Web3 technologies in financial services will be gradual or sudden? So I think this is probably quite an easy one for me to answer, that I fully expect that it'll be a phased transformation to Web3 technologies. I think we're actually seeing that already. There is that phase, and we've got a lot of good examples that we've talked about today of where Web3 technology is being used and is really improving some parts of financial services. But I think we are still a way off that widespread adoption piece. I know Web3 can feel like a little bit of a buzzword at times, and hopefully we've helped to dispel some of the myths around it. But it goes back to some of those key questions I mentioned. And I think for widespread adoption, what I believe we need is to really stay focused on what's the problem we're trying to solve. So don't just move towards Web3 for the sake of Web3, but think about what is the actual use case? What is the improvement that the customer is going to get from us implementing this technology or moving towards this aspect of Web3? And I think that is really how it needs to be approached as we start to adopt and integrate more of it into financial services. I will also just touch briefly on the regulation point. Financial services is a heavily regulated market, and I think without clarity on regulation for things like digital assets, there will still be, in my opinion, a reluctance to fully embrace these changes. It is easier in decentralized finance when it's some of the more kind of up and coming disruptors, but actually for traditional finance, where we are rooted in those centralized structures, I think this will naturally occur at a slower pace. Ewan, anything you wanted to add to that one before you pick a question?
Well, you've overlapped a little bit by touching into the regulations with one of the next questions. So how about I dive into that? So it was, how influential will regulation be in determining financial institutions' transition to Web3? I think you touched on the key points there, that within traditional finance, regulation is incredibly important, and regulatory risk is also something which all banks have to actively manage. So the regulatory burden on institutions has gone up significantly over the past couple of decades, and with all of the various different challenges that we've had, from terrorist financing through to the credit crunch, all of these have essentially just created new and more challenging regulatory frameworks. Engaging in Web3 ecosystems where there is much less clarity around who your counterparties could potentially be, who their counterparties are, and what their interests are as well, does give them a lot of exposure to future regulatory sanction. So I think that it will take them quite some time to work through with the actual financial regulators to be able to create a framework in which they're more confident in being able to engage with Web3. That said, though, there are products and services that do lend themselves, and there are the Web3 technologies that they can embrace directly and that will be fully compliant to be able to bring some of the benefits and the innovations through to their customers. And I think that's really important, is that regulating Web3 in of itself is going to be very challenging, and it's going to require regulators to think differently to how they have traditionally. The direct counterparty that we have relationship today, so where the regulator is able to engage directly with an organization and have a conversation with their leadership and their board, and their risk teams about what they're doing to comply with those risks is going to disappear. And instead, they're going to have these pseudonymous networks that are being run by a decentralized group of individuals across the globe, but that they don't necessarily have direct regulatory authority over. So be it that they coordinate more effectively across the globe, so regulator to regulator, or they approach how they actually identify and apply regulations and what the standards are that they're and outcomes that they're trying to achieve will need to shift slightly. So a change in approach to be able to make sure that they can still provide the same benefits and outcomes. So absolutely essential is the answer to the question. Very, very difficult to do. And I think there's a lot of discovery still to happen before we have the right regulatory framework for financial institutions to really adopt the whole of Web3. But there's an opportunity to adopt some of Web3 now, which is much safer.
Thanks, Ewan. And I think we've got 5 minutes left, so let's just pick one more question each. One of the ones I thought would be good to focus on is we were asked what we consider to be the key areas of financial services that can be improved by using Web3. And I think the reality is that we could go on for a very long time here. I think there's loads of opportunities to really improve different use cases across all of financial services. And actually, I'm happy to point anyone towards some of our thought leadership that looks at how this can really impact across banking, insurance, and cap markets. But just to pick a couple that I'm particularly interested in. So I think the first would be that typically banks are quite reliant on legacy infrastructure. If we take payments as an example, and cross-border payments particularly, this involves multiple intermediaries, multiple different players. And actually that interoperability between different geographies and payment systems is a real challenge. And I think through moving towards digital assets, such as central bank digital currencies, or having technology that is underpinned by distributed ledger technology, then that could really help to speed up and reduce the costs that are often associated with these cross-border payments. So I'm quite excited to see how that evolves and following the pilot that's going on at the moment. Similarly, a second one to call out is just smart contracts. So I know that Ewan talked about some of the uses of these and how we're moving from the kind of originally quite basic into the smarter contracts. And actually, I think this has real opportunity for processes and transactions to be improved, because actually you end up with a few lines of code that really have all the data and information that you need. And this can speed up things like trade finance, reconciliations. It's a real challenge for businesses when they're doing some of their banking, and also the ability to offer those highly customized products and services that I know Ewan referenced. But I will stop now just so we have time for one final question.
Thank you, Anna. It does yet again segue quite neatly into the one that I have, which is how can customers benefit from financial institutions Web3 adoption? And I think the answer is kind of top of my head is going to be there's 3 areas that I think are really, really going to be beneficial. The first is trust and transparency. So by embracing Web3 technologies and adoption, we know that centralized parties, there have been challenges around maintaining documentation, losing documentation, documents potentially being altered by people who, again, have not the best interests of the customers at heart. And that has created regulatory fines and sanctions. By moving over to Web3, you have that trust and transparency built into your networks and into the relationships that you have. So you can rely on the contracts that you have and the execution against those contracts, and you can validate it very easily. So it gives you a peace of mind and confidence in the relationships that you're managing. The second is around cheaper, faster, and new services. So with Web3, there is an opportunity to do things differently. New products can come to market, but also the cost of actually deploying a lot of your products and services can be reduced by leveraging the technologies as well. Automation benefits coming through, being able to automate the actual processes and the controls, and that cost saving can be passed on to customers, and it can improve their experiences as well. So a better user experience at a lower price point. And then the final one is around automation benefits. So using the technology to actually integrate in with your financial service provider at a much deeper and more meaningful level. And that will allow you to, again, automate things like your reconciliations processes, making sure that you're managing your supply chains, automating your invoice finance and factoring processes, be what they may, how you go about actually raising funds. A lot of that can be improved significantly leveraging the technology. So 3 points: trust, transparency, faster, cheaper, and better services, and automation.
Great. Unfortunately, I think that is all we have time for. If we didn't manage to get to your question, please do just reach out to us, and we're more than happy to have any follow-on chats. I will as well, before we close the webinar, just point you towards the slide that we're showing now. So we do have a Web3 Trailblazers podcast where, like I mentioned at the start, we speak to guests from industry and then also from Baringa to really unpick some of these topics in a bit more detail. But thank you everyone for making the time to join today.